Want to see someone systematically disprove everything you have read about trading stocks and expose how and why you will consistently lose money if you aren't doing it right? Click the link in the description to check it out for yourself. But now for today's video.
The question, what is stop loss in equity stock trading? Answer by Swamy. When you get into investment in the stock market, you are looking to make money. You do this by selecting the companies carefully, selecting the entry level carefully, and then buying into the company either in lump sum or in stages by way of INSIP. Once you have bought, the stock may go down or go up, and that is largely beyond your control. But having bought, you look at a time horizon of infinity to hold your stock, as long as the prospects of the company remains positive. Therefore, stop loss is not to be used for investing. Coming to trading, the stop loss may be used only to prevent the chance of a catastrophic and permanent loss of capital. Since the stocks you have bought are not expected to die in the short term, one may not use the stop loss here as well. Coming to derivatives, they have a limited life, at which point they expire and show huge volatility even on a daily basis. Sometimes moves are in the 100s of percentage points. Here, there is a high chance of your capital being lost. Therefore, only if you are having naked directional positions, like a call or put or a future in one direction, you will apply a stop order that will close out your position with a specified limited loss, either as a percentage of your capital or a fixed amount. Usually stops are triggered and the trade then turns around and goes back in your favor, with you not participating and pulling your hair out in frustration. When this reversal happens, you will theoretically re-enter when you think trade is going back your way. Usually with 23 stops triggered, you will be frozen with fear and indecision. So this kind of action does not usually happen. The other way is to create a hedge trade, which will make you a set amount of profit if you are correct and will lose a limited amount of money if you are wrong. For example, one strategy is to buy a stock and also take a short position as a hedge, either buy out of money puts or sell in the money calls. In derivatives, I found taking futures in my preferred direction and buying deep in the money options in the losing direction gives me a trade with a max loss in the single digits however far the stock goes the wrong way, and a profit proportionate to how far the stock goes in the preferred direction. Stops usually don't work, except for preventing catastrophic loss of capital. And if you don't know how to trade, stop losses will only result in death by 1,000 cuts. Instead of losing all in a single trade, you will lose it in multiple trades stop by stop. Answer by Donchandran K. As a lot would have pronounced already, SL or stop loss is a mechanism to prevent the excess loss that one could possibly run into in trading. Let's see it with an example. You have 10,000 rupees in your trading account. You buy 100 KT of ITC for 200 per script, i.e., the one-side transaction cost is 100 times 200 equals 20,000. You would be taking a leverage of double of what your capacity or total fund is, 10,000 times 2 times. Now, if the price is moving in your direction, i.e., from 200 to 210, you make 10 times 100 stocks equals 1,000 RS profit. But there will be swings in the trade and the price might go up and come down swingingly, before it could settle on a trend. So, even if the trend is against you, you don't want to lose your entire available capital of 10,000. So, smartly, what you do is, to keep a SL at 190, indicating something like, I bought at 200, I will sell if price goes high to 210, target, and I will auto sell if the price drops to 190 SL. So, if the stop loss is hit, I will restrict my loss to minus 10 times 100D equals minus 1,000. But if you miss this SL and God forbid the day is not yours, and if the price went down from 200 to 180 or 150 or what have you, your loss could never have been contained and you would be sitting the whole day hoping a trend reversal will happen, which will never happen, and at the end, if the CMP settles at 150, you will end up with a loss of 5,000, which is half of your capital. The turnaround would be 40,000, buy and sell, plus GST plus STT plus brokerage etc., maybe house rent, painting and parking charges too, and your total loss might be somewhere around 6,000. Imagine, if you have contained it using SL, loss would have been 1,000 plus change, and now without SL, it's 6,000. So, now you understand the importance of a stop loss in trading and decide if you should go for it. Cheers. Answer by Arpit Pauser. Stop loss is a safety trading tool used to prevent unnecessary losses and control trade with free stock trading tips. It generally found with the function of long or short. If the result of a trade gives us as adverse and losses are getting, the stop loss will kick in and restricted the trade at a determined point put by the trader. Let's discuss the advantage of using stop loss and recognize better when and how we require to put it. When trading with stop loss, while surely not an essential, many investors prefer to employ stop loss in our trading, mostly for the following reasons. Small equity account. Several new traders prefer to reduce losses as much as feasible while still creating occasional small income during their initial attempt. The stop loss plays a vital role in this consideration by keeping the losses under the traders managed so that they can decide a set amount of possibility for every target when trading, all in agreement with market and profits expectations. Tension-free trade. The forex market can be an uncertain beast at times, throwing off speculators' outlook due untrustworthy developments and travels. The result can be at times entirely unsuited to what one would normally suppose. Take a situation in which a trader visualizes the market turn to a bullish pattern should the basics go to be positive. However, consider do not go as probable and he has to experience substantial decrease. In such a circumstance, two sentiment every trader should attempt their utmost to stay away from: greed and fear, as what frequently occurs they end up down even more capital while trying to get well before the trades.